on to this model. In this model, we'll be talking about entry protocol. We'll be talking about entry protocol. What are the things you need to see before you make your entry. Now, um, following this protocol actually helps us to maximize our risk to reward ratio. There are times that um, making use of this kind of entry is really going to really help you minimize your losses. It's going to help you, of course, maximize your the profit to really maximize the profits, because there are times you may actually have as low as 2 pips stop, sometimes going to be having 5 pips stop, sometimes going to be having sometimes sub 10, below 10 pips stop. And when you're having below 10 pips stop and your target is about 60, 100, 200 pips, you know what that is going to do to your portfolio in the long term. So I really want you to pay attention to this lesson. Now, when you spot a supply or a demand zone that respect all the criteria that we've discussed in previous section, of course, there is no guarantee that the trade is going to go in your favor, because the market is the market. The market does what it does. Okay. So because this is only a method that allows you to follow banks and financial institution footprints, and of course, like I was saying, it doesn't really guarantee that that just entering um into a trade blindly at that order block, at the order block that you have marked in the higher time frame, in your higher time frame, that other block is going to hold. There is no guarantee. So until you see certain things in the market that points you that yes, the market is truly going to go in that direction, those are the things we really want to look at. So when you qualify a valid supply and demand zone, you always need to see if the zone responds or not. So if this zone responds, the market will give you a signal in form of a price action to confirm your entry. Now, those are and now we want to discuss what you should look for before making an entry. Okay. Now, I want you to pay attention to the two charts um, the two diagrams we have on the screen right now. Now, this is our entry model, and I really want you to pay a very close attention, okay? All right, now you can see this bar here. This horizontal bar represents your higher time frame supply, okay? The higher time frame supply, whether you actually draw this from your from your 4 hour or your monthly or your weekly or daily, it doesn't matter whether you're a day trader that drew this that I mean using 1 hour chart or 30 minutes or 15 minutes as the case might be as your HTF. Now you have marked that zone, you know, from your higher time frame with this particular bar here. It is supply zone. Now, what you're going to do, okay, is to simply wait for price to simply, you know, come back into that particular zone that you have marked. And once price comes into that zone, you switch immediately to your lower time frame. Now, let me quickly just talk about the lower time frame. Um, if you draw your higher time frame, if you're using 30 minutes or or if you're using 30 minutes or you're using 1 hour or H4 as the higher time frame, your LTF, that is your lower time frame entry model, should be some people use 15 minutes, and some people use 5 minutes, some people use 1 minute, okay? But for me, I think I'm fine with 5 minutes. So immediately price pulls into that particular place, I switch to 5 minutes. If this my higher time frame is from 4 hour or 1 hour or 30 minutes, okay, I switch to 5 minutes. But if the area I've marked is from monthly zone, or is from the weekly zone, or from daily zone, I actually want to break it down to 1 hour first to really see what happens on 1 hour chart before I begin to look for my entries. Okay, if if your supply if your higher time frame, for example, is from 15 minutes, then of course you can use 1 minute as your lower time frame entry entry model. Okay, now let's quickly look at this. Now, like I was telling you the other time, you understand the market structure up until this particular point, right? So you've already marked a supply zone. Okay, you've already marked a supply zone on the higher time frame, and when market we decide to move into that particular place, what will it do? It's going to form a series of higher highs and higher lows, might even range along the way before it touched down to come and mitigate that particular place. So when price pull into that the other block of the higher time frame, now you switch immediately to the lower time frame to see this kind of a structure. You want to see, look at this is the last support before price pushed into that hobby, into that supply area. Okay, on the lower time frame. Now on the lower time frame, this is the last support on the lower time frame. Please pay attention. On the lower time frame, this is the last support. Okay, before price pull into that, into that supply area. And look at, there was a a bounce to the downside, but it did not break. Okay, it didn't break the support. All right. Now there was a pull again to the upside, and of course it didn't take out the resistance as well. So this particular move this time around broke the support. That is the support that was there before the price touched in to mitigate that supply area, and eventually that support was broken. So we are going to look for the other block that was responsible, that other block that was responsible for the move that broke that broke the the support. Okay, so we simply just wait for price to pull back into that particular area. That is where we're going to be taking our entry. Okay, it's a very safe way of trading. All right, it's a very safe way of trading. You simply just want to see now, you want to see that change in character. Okay, this is what we call the change in character, because what you have here is going to be a series of higher highs and higher lows, higher highs and higher low before it actually got into that particular supply area. And you want to see a reversal of trend. That reversal of trend is what we call change of character. All right, so when you now see that change of character, the OB on the lower time frame, now the other block that caused the break of that structure, that break of structure to the downside, that is what is going to be your entry. What your entry will be, you can actually make your entry at the proximal line. Okay, at the proximal, or you may decide to take the 50% of that particular order block. Meanwhile, your stop loss is going to be at the distal line. Okay, your stop loss is going to be at the distal, while your take profit is going to be at the last demand and at the last demand area. Now that is for your entry in supply. The opposite is true. The opposite is true for demand. If you look at this the other diagram, the second diagram, you can see the HTF, the demand. Okay, so you have marked out the area on your higher time frame, and when price pull into that other block, you simply just switch into your lower time frame. For a demand, when price is actually coming back, it's going to be making series of lower highs and lower lows. Lower highs and lower lows might even have form some equal lows and equal highs, forming some sort of liquidity in the market before it finally break into that. Now all you just want to do is just want to wait for price to actually touch down into the other block from the higher time frame. All right, so when you now break into, I mean, when it comes into that other block, you want to see that where is that last resistance point before price pull into it. I mean, it pull into your other block from the higher time frame. So you are looking at the lower time frame from this point forward. Now, when price eventually break, when price eventually break the resistance, which is what actually happened here. Okay, so price actually broke the last resistance to the upside, and you know are going to be having our whole B, that is our order block, at this particular point. Now you are going to be making your entry at the proximal here, and of course if you want to, if you can also make your entry, you can take your entry at the 50% of your order block, and your stop loss is going to be just a little bit below the distal line. Okay, now you may have to go over this over and over again for you to understand the theory behind this particular entry. Certainly we're going to be doing more of practicals from this point forward. I see you in the next.